Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis. Taking Stock, episode number 33. It is good to be back with you again on this this gorgeous Tuesday. But
absolutely beautiful.
So how's life treating you?
Well, better than I deserve. Let's put it that way.
I like it. Well, I don't know about whether it's better than you deserve, but it's good to hear. So life is well. And I know we were talking before we started this session, and it's great to hear. So you've started this regimen, and you're doing some walking and running and stuff, and it seems like you're feeling good effects from that.
Yeah, no doubt. It's I'd like to stick around for a while, so maybe make a little bit of a concerted effort to make that happen.
There you go.
Not that I have complete control over that, but we'll see what happens.
Well, you want to you want to be around to spend some of that money that you've accumulated in investing and so on to take care of that Jarvis family wealth, so to speak. Wealth management.
Yes. Well, it would be nice. There's a lot of the world I would still like to see, but the other side of the coin is there's a lot of good that can still be done in the world too. So we'll stick around and see if we can stir the pot on this side, and on this side make the pot a little bit better. So
well, I like that. Well, so a side message there that I'm hearing from you. So not just trying to take care of yourself to enjoy, but to continue to serve and to hopefully help do some good in this world.
Yeah, most definitely. So, we won't turn this into a religious podcast here, but
we can.
I do believe in your gifts, and I do believe in your resources and your talents that you're given, and I do believe that you are to take those things that you've been given and put them to good use. So
excellent. Yeah. Well, we call this Taking Stock. And it looks like you took a little stock of yourself and added a little program to to continue to we hear this a lot today. At least I seem to hear this a lot. To become the best version of yourself, to become the best version of ourselves, and that's a good thing. So, how's the U.S. economy? How's the marketplace doing? As we take stock of that's what we're here for every 2 weeks, is how are we doing in becoming the best version of our marketplace, the best version of our economy? What's happening?
Sure. Well, I would still submit to you that we're doing all right. We've had some inflation numbers since we last talked, and we'll start with that because we talk about that pretty much every episode, because 2 years ago we were banging up against 9-10% inflation. But if you look at the PCE, the personal consumption expenditure indicator that the Fed uses, that's down to 2.6%. So that continues to drop. They just revised the gross domestic product number, and if you remember, they came out and they were looking for I can't remember, 1.1% or something like that, and it came in at 2.8. It just completely was way better than expected. Well, they just revised that again in the last week or so, and now it went from 2.8 to 3.2. So not only is it better than what they were expecting, it's continuing to get better, period. So, you take that and couple it with all the other numbers we look at and things, I still submit to you that I don't see anything in the near future that, says we're going to slow down. Now, the interesting thing today, Tuesday, September 3rd.
Correct.
The market's down 1.5% today. So, we had 4 or 5 weeks ago, the market dropped 8 or 9% over a 3-day period. We spent the next 4 weeks not only working our way back up, but we actually started hitting new highs again. So that was that was because of the recession word. So not only did we do that, but the problem is we went from 4,200 something like that back in October of 23. We went up to almost 5,700, and then we dropped back down to like 5,200, and then we're back up to 5,600. The problem is we're doing all this bouncing around, but there's not really a great reason for us to push way higher than 5,700 on the S&P. That's a pretty good number. We need some time. We need some lower interest rates. We need some higher earnings projections or something. So the problem is if there's not a good reason to push higher, then we start looking for a reason to push lower, right? And that's kind of where we are today. We got a manufacturing report this morning, and it's just to use the numbers. It came in at 47.2. Well, they were looking for 47.9. Well, the August number was still better than the July number, so which means it's still improving. It's not like a hit the ball out of the park kind of number, but it's still improving. But here we are today, down 1.5%, because people didn't like the manufacturing number, coupled with the fact that we've still got some drama going on in Israel and things like that. So,
well, for me, and for maybe some of our listeners, that 47 manufacturing number, what did you say? It came in at 47.2.
0.2. Right.
They were hoping for 47.9. 47.2 represents what?
Well, that's just the increase in the manufacturing, not productivity, but the level of confidence in where those manufacturers think things are going to be. So that number can be much higher than 47.
Right.
But the problem is we talk about and look at the trend.
So is that like a percent of increase in manufacturing goods, or how? I'm guessing there's a lot of factors that go in to create a number that's called 47.
That is correct. It's more of an absolute number, so
right,
it's more. It's not a percentage number, so it's not saying, hey, we increased by 47% or anything like that.
Right.
If July. If July was 46.9 and this month we were at 47.2, we basically went up 0.3. And it's not even a percentage, but we went up 0.3. Well, I still submit to you, we're up 0.3 from the last month. So we didn't get what we wanted. We still got a better number, and we still got a number that's relatively positive. So,
well, another question that I think stems from what you're sharing is this up and down number. So this is Taking Stock episode 33.
Yeah.
All right, which puts us, are you ready for this? 14 weeks, only 7 episodes, but 14 weeks into year 2.
Right.
And so we've seen some rise and fall and rise and fall. What would you say in 1 year, the last 15 months, I won't do it 1 year and 3 months, so the last 15 months since the first episode of Taking Stock, what I'm hearing is, we're kind of holding steady.
Yeah.
I mean, there's been some rises and there have been some falls, and then it rises again and it falls again. If I had a value of my portfolio at, 15 months ago, whatever that was, some number, do I look back and say, well, you know what, I'm pretty much where I was 15 months ago, with maybe slight gains, but not necessarily loss, pretty much holding steady. What would you say?
And again, it depends what's our starting point. So if we say from October 27th of 2023, our portfolios are up a lot from that point, from that bottom. That was the bottom.
Right.
Okay, so that's pretty close to, what is it? But we're coming up on a year. So if you go back, so we have definitely improved. The stock market has improved. Now, like you said,
so there should be gains.
Should be
for somebody's
gains.
That's the point. So it hasn't been, despite some some rise and fall, this little bit of a roller coaster ride over the last. We'll just say the last year instead of those 15 months, because as you said, October to October, there's been significant gain since October of 2023, and whatever your investment portfolio is, whoever you are out there, you should have seen gains despite any of those periods of loss. It shouldn't have been. We shouldn't have lost in our.
You're absolutely correct. I mean, so if I always, when I show my clients their performance, I show them the U.S. market, equity market, stock market. I show them the international markets. I show them the bond portfolio. I show them small caps. I show them blended index. I show them all these different kind of benchmarks so they can compare how they're doing. Every single benchmark is up. Now, let's say bonds are up, let's say 4.8%. I think that's the last number I looked at. Bonds are up 4 points. So even bonds are up 4.8%.
Yeah.
But you're depending on where you are on the risk curve. If you're real conservative, this won't be a true statement. But even if you're in a 75, 25, 60, 40 kind of blended portfolio, in the last year you should be up somewhere in the double digits. Okay. Now, if you're 100% stock, you're closer to that 20% number. If you have some bonds in your portfolio, you're going to be more in that 10, 11, 12% number. But you should definitely be up. Now, that's as of today, right?
Right.
4 weeks ago that number was a lot lower. Here we are again. We're back up again, and it has been back. But I'll say it one more time. It's like we're experiencing this volatility because, frankly, there's not really a great reason for us to push much higher than what we are, or were anyway, a couple of days ago. But there's not a great reason for the market to drop. For the market to drop 10, 15% either, right? So we're kind of stuck. We need, and there's the big discussion, right? We need lower interest rates. Okay, we need higher corporate earnings. We need the economy to start growing even faster than what it is, which I'm not sure that's a thing, but or something that we need. But we're talking. So now we're in September. The Federal Reserve is going to meet on September 17th, September 18th, and on the 18th, it's almost a foregone conclusion that we're going to get a quarter point decrease in rates. Okay,
right.
If we don't get that quarter point, people are not.
So when's that meet? September what?
So they'll make that interest rate announcement on Wednesday, September 18th. So they'll meet on Tuesday the 17th, and Wednesday the 18th they'll make the announcement on the 18th. But again, pretty much it's almost a 100% probability that we're going to get a quarter point cut unless something changes.
Now that said, so 15 days from now, when we get to that September 18th, which is going to be the day after our next episode, just for the record.
That's right.
But when that hits, we might hold off and just record that the day after, so we can
we're flexible here.
We can account for that. But the point is, the immediate aftermath, if that near foregone conclusion, almost 100% certainty that we're going to see that quarter point drop in the interest rate, which everybody would love to see, everybody's eager to have happen. But if it doesn't, everything's going to go crazy on September the 19th for a minute.
No bueno.
Right? No bueno. En Espanol, no bueno.
It's bad thing.
And Americano, no good.
But here's the thing, that quarter point, basically, it's already priced into the bond market. You could say it's also priced into the stock market, that they're already, it's a done deal, according, in people's heads. We're so much to the point that there's a 1/3 or a 0.3% chance, or a 30% chance, that we might get a half point. Yeah. Well, to me, that's fantasy. Okay, we're not going to get a half point. They're not going to start. Well, I've been wrong before, but they're not going to start with a half a point. Okay, and to me, the initial reaction might be oh, good, we got a half a point. But to me, then you got to look at it and say, why did we get a half a point cut? Is the economy doing something that I'm not aware of? Are they seeing something in the numbers that they look at that maybe points to something more negative than what I'm seeing, right? And that's how people will react to that. So they might initially be happy, but then it's okay, why did we get a half a point cut? But I still submit to you that we're not quarter point. But the problem then is okay, we get it's buy the rumor and sell the news, right? So we've been buying, the markets have been going up, doing well. based on almost a foregone conclusion we're going to get a quarter point. We get the quarter point. Now what do? Now the discussion becomes, well, when are we going to get the next quarter point?
Yeah.
So,
where does, in our conversations, in our probably last 3 or 4 episodes, so over the course of the last 2 months, we've talked a lot about, the tech stock world because of, what is it? Your favorite.
NVIDIA. The darling of Wall Street.
The darling of Wall Street. That seems to have settled out a little bit. Yes?
It's actually been trading basically sideways for the last 2 or 3 months. Yeah.
Yeah.
Because it got up and it topped out at like 140. It's down pretty good. It's down probably 10% or so today or somewhere in that now. And so it's at like 113. So, but it's been bouncing around in the range. It needs to take a breather because the last year or so, that stock has grown substantially. Now, in fairness, they also reported earnings last week.
Well, this is what I was going to ask.
Okay, go ahead.
You're jumping right in to where I was leading with that was how have their earnings looked on their most recent earnings reports?
Year over year, they more than doubled. Their revenue was up by 122% from year over year. They were looking for a 64 cents per share number. They got a 68 cent per share. So in my world, they hit it out of the park. So not only was it a really good number, but it was a much better than expected number too. Okay, so but interesting enough, in some ways, it wasn't good enough, right? So I mean, it's back when I first started this journey, early 90s, if someone came out and they were supposed to report 50 cents per share and they reported 50, everybody, they hit their number, and I was like, okay, that's good. Yeah. And then somewhere not too long after that, okay, they want 50 cents, they got 50 cents, well, that's not good enough. We want them to beat the number, and that's why we sit there and talk that like if we're looking.
Well, we don't want you to make the playoffs. We want you to go all the way.
We want you to win the playoff, right? Exactly.
Go to the World Series. Go to the Super Bowl. Go to the Stanley Cup Finals. Or whatever the next thing, whatever your sport is.
Yeah. It's surprising.
Those are mine.
Yeah. Right. No, exactly, and that's a good analogy. Surprise me. Impress me. Right? Well, okay, you did what you said you were going to do. Well, that's not impressive. I want you to surprise me, right? So, then you start to wonder, how many games are the corporations playing, But
you just touched on that's a funny comment. So, you did what you said you were going to do.
Mm-hmm. Man, that's not good enough.
Well, and then that's the and that's not good enough.
Yeah.
Yet, since we're in this election period, and there's a lot of political rhetoric being, spewed out there. Mm-hmm. Did what you said you were going to do. Yeah. Well, wouldn't that be nice?
I would take, from a political standpoint, I'll take that all day.
Anyway, except, and we're going to sidetrack just for a second, and I got into all kinds of trouble on the social media last week, and you may or may not be aware of it. So I got to thinking about that, and Sue and I having a conversation. There was a time, and what we just said, do what you say you're going to do. Mm-hmm. And so politicians across the board, from right in your own backyard and your own community to the guys that are being elected at the highest level to the President of the United States or whatever, make promises. This is what I'm going to do if you elect me. Right. And so we wanted them to do it, and we wish they would. And so what got me in trouble last week is, and I just posted this because Sue and I were talking about it, and I said, there was a time when we truly wanted the politicians to do what they said they were going to do, keep the promises they make. Yeah. Today, and you choose your side, I think people are sitting there going, oh my God, I hope I hope he doesn't get elected. Keep those promises, or whoever that may be, whatever. Because promises today bring fear about where we're going if this side gets elected or that side gets elected. So anyway, I got in all kinds of trouble.
Well, yeah. Well, and that's the thing. That's the problem with social media. You know, right. You put something out there, and people are going to tee off on it. But yeah, so and let's see. I try.
Oh, back on to taking stock.
Well, I keep to try and keep this as apolitical as possible, right? But yeah, I mean, there's things that I look at, and there's promises being or things being said or promises being made on one side of the aisle, and it comes down to the talk about taxing unrealized gains in your portfolio. So right now, you don't get taxed on your gains unless you sell it.
Right, unless it's an actual in your pocket gain.
A taxable event actually happens for you to get taxed, okay? And that's, let's just say you get taxed 15% on your gains. Well, there's this discussion now about taxing unrealized gains.
Correct.
Which sounds like a god-awful idea to me. It sounds like a nightmare for a lot of reasons. It sounds very bad for the economy, in my opinion, and things like that. And let's just say I'm not a fan.
Well, I think from the point of view of this show, taking stock, and what's going on in the economy, what's going on in the money marketplace, the stocks, the bonds, the whole thing, and what's happening with your personal investing, whoever you are out there listening right now. From that point of view, what you're talking about is why it's important for people who are in the market that have investments and are trying to protect, what do we want to call it, their personal wealth. That term today is big time, the wealth management. So whatever your wealth is, from the lowest level to the highest level of wealth management. And I think, you make a point about that, apolitical. It's important, people, for us to think about and understand what policies will do to your investing. So from a taking stock point of view in this show, that I don't think that's a political statement. That's saying, hey, you know what? I have clients who have unrealized gains. Yeah. And, there's nothing you can do. I mean, if the laws become whatever they would that would now tax unrealized gains, that's going to have a huge impact on your clients and all of us individually investing one way or the other. And it's something that people need to know that. I think it's a good point for you to bring up. As I'm not the expert on this show. Professor Jarvis has his professor's hat on again for a minute, talking about a piece of this, and he gets mad when I call him Professor Jarvis, just for you guys listening. But the point is that you've been doing this for a while, closer to 40 years than 30. Sorry,
much closer. Yeah.
but anyway, but the point is, you have been through it. You've learned the lessons, and sharing those on this show. That's the whole point of taking stock with Art Jarvis, is to share the lessons and to help understand what is happening, even if it's not always a lesson. It's just sometimes it's the news of what's happening in the marketplace and what's happening in the U.S. economy, the world economy, globally and at home and in your own wallet.
100%. And these are the things that I think about when I'm out walking, jogging, crawling, whatever it is that I do. But yeah, I mean, you sit there, so I'm constantly looking at securities that are in the portfolio, and I'm trying to make a decision, and if it's in a tax exempt portfolio in an IRA or something like that, it doesn't matter whether I sell it or not because there's no tax consequences, okay, at this moment in time. But let's say it's in a personal portfolio and it's a taxable portfolio, and we'll just say XYZ stock, XYZ stock. It's getting a little toppy, and maybe I think it's getting a little too high. It's gone a little bit too far, too fast. I have to make a decision whether do I want to get out of that stock, or do I want to hang on to it and stick with it and be willing to accept maybe a little bit of a drop. But if I know it's going to cost me 15% in taxes to sell a stock, now I got to decide: do I think this stock is going to drop 15%? Or do I think it's going to drop 10, or do I think it's going to drop 20? But the point is I'm trying to make an investment decision, right? What my initial response to what's being proposed is you're taking some of my ability to make an investment decision away. And honestly, I haven't chewed on it long enough to really get a great idea what that causes in that kind of thing. So if you're forced to pay 25% capital gains tax on something that you haven't taken a realized gain on, okay, so that's an event. But what do the future events look like? So what happens if that stock drops?
That's the point.
It's like what happens if the stock continues to go up? And it's and the other thing is if you got to pay taxes, then do you have to take money out of your personal portfolio to pay the taxes too? So does that mean I have to sell something else to actually be able to pay my taxes, which causes a taxable event? So now you're paying taxes on the taxes.
Right.
That's my gut reaction to it.
Yeah.
So yeah.
Well, and you preface that with you haven't really dug all the way deep into it yet, but that's a pretty deep dive already.
Uncertainty.
And it's
we don't like uncertainty, Chuck.
No. Yeah. Well, again, at the end of the day, for the listeners at home that just heard that discussion, forget about your politics, what you like or don't like, or who you like or don't like. You pay attention to what it means.
Yeah.
That, at the end of the day, is what does it mean? Yeah. What does it mean for you? What does it mean for all of us? What does it mean for the health of our economy overall? What does it mean for the health? Today, it's like, what does it mean for the health of our freedoms? I mean, that starts to, tax on your tax.
Yeah.
That's a scary thought.
That's an ugly thing. It really is.
That's a really scary thought. I don't want to hear it. We shall talk about it no more.
Well, honestly, we'll see how it goes, because we may be talking about it some more. Especially if I maybe have a little more information to make an even more intelligent discussion. But I do want to. You asked me a question about being a year ago or 15 months ago.
Right.
So, from a portfolio standpoint, you should be better off today than you were a year ago or 15 months ago.
That's good.
You should. If you look at it from an economic standpoint,
I'm going to look. Sue and I are going to look at our numbers now after this show, just because I'm really curious on that. I think we're fine, and I think it'll match with what you're saying. But it'll just be interesting to see.
Well, if not, I know you're an investment advisor.
Excellent. I'll ask you for her name.
Yeah, her name's Caitlin. Anyway,
perfect.
But yeah, exactly.
There you go, Caitlin.
But it's if you look at our gross domestic product, we're better today than we were a year ago. If you look at our inflation numbers, we're better today than we were a year ago. Prefaced with the fact that we were in the basement a year ago. A year ago or 15 months ago, whatever it was, we were looking at 9 to 10% inflation. Now we're talking about 2.5 to 3% inflation. So that number's better. But if you go to the store or you go to the gas pump, it might be better than it was a year ago, but it's not better than it was 3 or 4 years ago, right?
I don't want to be the bearer of the bad news, the man delivering the doom and gloom. But I always, when we get into this, the inflation's better. I always want, you sticking me with this is what's happening.
That's right.
I'm the one that reminds everybody what that actually means is, so when we were at like double-digit inflation, however many months ago, and everybody was up in arms about it, but it's gotten back down. Well, the prices went up, and we inflated, Well, now they're only inflating, and that's where I'm delivering the bad news. They're still inflating. The inflation rate isn't saying, so we dropped 7. No, the prices didn't drop 7% or 6.5% or 6.4, whatever it was, to the 3.2. What are we at right today?
Depends on what number you look at, but the Fed one is at 2.6.
Okay, well,
anyway. The CPI is at 2.9. Yeah.
Well, we'll just stick with the 2. So we're all the way down to 2.6% inflation rate, which means prices are going up.
Correct.
by that.
Correct.
They're not dropping by the, 7.5% or 7.6% that was once a 10.2% inflation rate
Exactly
or whatever
right.
it was.
Exactly right.
And so, and I hate to bear the bad news, but that's the facts. And so now here we are with like a minute to go
Okay.
in this edition. This episode of Taking Stock is coming to a close, Art.
Okay.
We've had way too much fun. It flew by. But, to get quickly off of that sad note of inflation numbers.
Yeah. We're going to
even though
positive.
No, it is the positive is the inflation numbers are lower. Thanks be to God.
But I still say that cheeseburger that used to be $6, that cheeseburger is still $12 now. Right? We use the cheeseburger analogy, and that cheeseburger that whatever period of time ago, 3 years ago, was $6. If I go and buy that same cheeseburger, it's $12 now.
I gotcha.
Okay, so
yeah. Well,
chew on that.
You know what? I got to test. So we just had Labor Day weekend,
Yeah.
and all kinds of things. Fried chicken dinner.
Okay.
And I'm not going to name a place or anything, but there is a place here. We're here in beautiful, as I like to say, lovely Loveland, Ohio. So there's a place that's nearby, pretty well known for their chicken. And Sue and I just went for the fried chicken dinner.
Yep.
Fried chicken dinner.
Yeah.
$60
For the two of
for
them?
the two of us.
Yeah. Yeah.
Now, that included, a piece of pie for dessert.
Okay.
And of course today you also pay, if you get a soda, or forget about no alcoholic drinks with this meal, but just like an iced tea or whatever, and your favorite pop or soda or whatever you call it. But $60. That's before tip.
Sure. Okay. I mean, that's where we are, and it's
Yeah.
not going unless something really bad happens in the world. We're not going back down.
Yeah.
Yeah.
Well, and by the way, it wasn't that place called KFC.
No, I believe you.
Just for the record.
Although, let's be clear, if you go to McDonald's or Wendy's for two people now, it's $20.
Oh, easily.
Yeah.
No doubt about it.
But when did that happen?
So now, was that me a minute ago that said we're coming to the end?
Yeah, we got
Let's
1
finish
minute
on a finish on a positive note. Well, hey, so a quick reminder.
Yeah.
A quick reminder. What Art shared with us today is that looking back at that 12-month or 15-month period, you're up.
Yes.
So, in summary, that things are trending in a very positive direction.
I think so, and as we always say, I don't see any reason not to stick to the plan.
Excellent.
There you
And
go.
on that note, we'll stick to the plan. We've run out of time on Taking Stock episode number 33. Art Jarvis, thank you so much for joining us and sharing your insights today.
Absolute pleasure. Appreciate you.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.